According to supply managers in the 9 Mid-America states, how is the economy performing?
Our Creighton survey of supply managers in manufacturing for the 9 Mid-America states, the overall reading was slightly above, and this is for August, slightly above growth neutral, 50.5, and that's from July's 49.4. What we're seeing is bouncing above and below, like a stone skimming across the water or the lake. It's up and down like that, below and above growth neutral. So what we're seeing is the economy is moving sideways. I would say a bit on the higher side of growth neutral. So we're seeing some growth there, but not enough to send home about. Import readings, not anything great. In fact, import reading was 35.9, and that's down from 36.3 in July, which was also not good. What we saw is a lot of importation in advance of the tariffs, and that was, of course, in April, the increase there. And then we've seen exports, and exports not doing well at all, 39.5 from 38.3 in July. So tariffs are having some significant impacts, and I think the impacts are it's just spreading across the globe. It's not just the U.S., it's other nations, and it's hurting the economy, hurting the U.S. economy, hurting the global economy. And 4 out of 5 report tariffs pushing prices higher. Now, not significantly higher, but higher. And we'll get that, we've got that PPI, the PPI, Producer Price Index, which is a part of our survey. And that's been growing, but it's not being passed on to the consumers. So where is it going? It's cutting profit margins. In other words, businesses are absorbing the price increase, the tariff increase, and also the importers and the distributors, and of course the exporters that's outside the U.S. exporting into the U.S. We're on the import side. Here I'll bring up the graph of the indices that we're tracking there, and those are 3 indices. The red you'll see is the U.S. PMI, Purchasing Management Index. That's the same as our index. In other words, they're surveying supply managers. We're surveying supply managers in manufacturing both. And as you see, it's skimming across the bottom like ours. That's ours in Creighton, beautiful Creighton blue there. And you see it came down significantly. Now it's bumping along. And then the other reading there is for the rural areas. So all in all, it's just an economy that's on the verge of some good things, on the verge of some bad things. And I think we're going to see I'll talk about it later on, what we're going to see going forward. So again, not a good picture, but not a bad picture, just okay.
What were the hiring trends?
Hiring was not good. August hiring index was 45.6, a bit up from July's 45.4, so I guess it's up, but it's still below growth neutral, still seeing job losses. Now, if we look at the additions to the U.S., now, again, this is for total non-farm. If we look at total non-farm, the region has added jobs, about 1%, and then the U.S. has added 1% in terms of overall non-farm. Now, manufacturing, not so good in the U.S. U.S. has lost 13,000 jobs. That's for entire manufacturing sector, and that's not much. That's 0.9 of 1 percentage point. And the region is actually, over the last year, I'm talking about year over year, has gained some jobs, but you wouldn't know it. We're just not seeing enough growth in manufacturing jobs, and it's showing up in the manufacturing economy.
What inflation trends are you noticing?
Inflation, it's not good. By that I mean we're seeing too much inflationary pressures for an economy that's weakening. And you say weakening, no, moving sideways is probably a better term. But overall, the general trend is up and down, as I said. And the index declined to 64.9. That's down from 69.7. So the good news is the inflation index is down. The bad news is still too high. Supply managers reported that tariffs had pushed the prices they have to pay for inputs higher. So the idea that somehow tariffs aren't showing up is wrong. And our supply managers are saying that. And about 20% said no impact at all. So 80%, 8 out of 10 supply managers said these tariffs are having some impacts in terms of increasing the prices they pay. Now, in terms of what happens to the consumer down the line, not so much there. And keep an eye on the CPI. The CPI is now, if you look at the last 3 months annualized, about 2.4%. If you look at the core, about 2.4%. So the Fed is, I won't say they're keeping prices in line. The CPI is just remaining in line because of some weakness, I would say. And if you look at the PPI, the Producer Price Index, you're talking about some hefty numbers there, 5.2%. Now, I'm taking the last 3 months and annualizing it. And of course, we had that huge number last month. And of course, this month's not so good either. And a core is up by 3.6%. Again, 3 months annualized. That's too strong. So again, we're seeing prices rise at the what is often called the wholesale. It's actually the Producer Price Index, and that's what we're recording, and it's showing too much inflationary pressures, and some of that a lot of it can be traced to tariffs. And the year-over-year inflation index, too high for the Fed. Still, the Fed's going to be, they're caught between a rock and a hard place. Too much inflation, too slow of an economy.
What is the economic outlook?
Fed, in terms of the Federal Reserve, the open market committee, they set rates. They meet again September the 16th and 17th. They're going to reduce interest rates by 0.25%, 25 basis points. Again, they're caught between a rock and a hard place. By that, the hard place is higher inflationary pressures at the wholesale level, not so much, but still above their target. And they're caught between a slowing economy and slowing fairly significantly. And here's the key. Here's a key thing. Those employment numbers that we're getting, and we'll get this Friday. This Friday is going to show some employment. They show some employment gains, hopefully, but it could be a downturn. Those numbers are just wacky. They're up and down. And what happened one month, over the last month, they had 250,000 jobs from the government added in, and that's I won't call it cheating on the BLS's Bureau of Labor Statistics part, but it's. President Trump may have a point there that these numbers are just not, they just can't be relied upon, the monthly numbers. And if you look at the CPI, is probably going to come in, is moving lower probably, but don't take any comfort in that. From the short term, we're going to probably see prices remain in line, but look for intermediate and long-term prices higher. But again, that's intermediate to long term. And if you look at long-term interest rates, those that'd be mortgage rates. So here's the very, very important point, not necessarily because I'm saying it, because it's just a fact. If there are economic facts, most economics are somewhere between fact and fiction. This is more on the fact side. The last time the Federal Reserve reduced interest rates by 1 percentage point, that was for the elections. Of course, that didn't make Mr. President Trump very happy. They reduced short-term rates, but long-term rates went up. Now, what caused that? And I think it's going to happen again. Now, long-term rates may come down right around the announcement, but they're going to go back up. Long-term rates are influenced not by what the Fed does, but what investors do. And investors see too much inflationary pressures. So mortgage rates are going to bump down a bit. But again, long-term, intermediate term, higher. Mortgage rates are just going to be too high for you out there, and that's not going to be good for housing. Speaking of housing is, it's not good. And it depends. Of course, housing, those of you who are watching this, depends on where you live. If you live in the Midwest, as I do, they call Ohio Midwest. I hate to tell you folks, it's not the Midwest. The Midwest, what is Nebraska? What is Iowa? Gosh, I mean, if Ohio is the Midwest, I mean, you go leave Ohio, you've got to go through a few states to get to Nebraska, get to the real Midwest. And what the Midwest is, the housing's not as weak here. You're not going to see as much weakness. Look at Florida, look at Arizona, look at Texas, look at Georgia. The Southeast and Southwest, some real issues in housing. The housing prices, the growth has been overstated because of sellers. That would be a lot of construction companies that are selling, and they're giving price breaks all over the place. In other words, buying the interest rates down. That's one tactic. So the prices are overstated, the growth. And the Case-Shiller Home Price Index that came out last week, still showing growth. It's a fiction. It's a fiction because it's the U.S. average, and there is no U.S. average. It's a bunch of different markets together, and overall the housing sector is declining. Keep an eye on the bond market. We're talking about a bond market that's giving you the signals, and the signal right now is investors are waltzing past the graveyard right now. What do I mean by that? Failing to recognize the risk. How do I know that? The yield on the junk bond is too low compared to a risk-free rate. The risk-free rate is the U.S. Treasury bond, and that's the gap between the two is 2.4% right now. Junk bond, risky, non-risky. It should be higher. It's at record low levels. That's not where it should be. And what's happening is there are a lot of young investors out there that have not seen interest rates high. They're not used to they're used to low interest rates. They think got to get back to those low. We're not going back to low interest rates. The Fed's not going there, and so get used to it. We're going to see that. Look at oil prices moving lower. Now, why are oil prices moving lower? Because the economy is slowing down. Manufacturing is, I won't say it's slowing down, it's just not picking up. Construction is coming down. That's what we're construction activity. So mortgage rates are likely to come down a bit, as I said, but then they're going to spring back higher. So once they come down in September, if they do, now I'm not saying they will, but I'm betting on long-term interest rates, and that's somewhat a big issue. Keep an eye on every Thursday, the first-time claims for unemployment insurance. That's just the strangest thing. We've got some very strange data coming out for an economist who's been around a few years, and as you probably can tell, I've been around a few years, and they're very strange. Unemployment numbers, those are going to tick up, but we're not seeing it in first-time claims for unemployment insurance. So anyway, keep an eye on the Federal Reserve's balance sheet. That's the number when they panic. They panic and go in and bail out whomever is hurting, particularly if big banks. Too big to fail, that's their idea. And as I said, keep an eye on, listen carefully to what the bankers are saying. That's the Federal Reserve. Of course, now they're dealing with President Trump, of course, the battle between President Trump and Fed Governor Lisa Cook and Fed Chairman Powell, Jay Powell. They're not big buddies, as you well know. Some of that's going to be settled in the Supreme Court. I don't want to get into that. I'm having enough trouble with economics, so keep an eye on that battle. But again, there's some real games playing, and some of it's going to be settled in the Supreme Court, unfortunately. And as an economist, I sure don't like to get into the legal area, but we're going to be dealing with it. And keep an eye on that employment report this Friday, the first Friday of the month. If that number comes in as I expect it to be weak, I expect it to be weak. Now, what's weak? Below 50,000. It could even be negative. Could be negative. If it's above 200,000 and the CPI in the middle of the month comes up higher than expected, the Fed may pull back and say, no, we can't reduce interest rates. That could happen. I don't think it's going to happen. It could. Now, what's likely to happen, my expectations are not a good employment report, which means the Fed needs to cut rates. And if that employment report is really bad, it could be a 50 basis points or 0.5%. Now, what does that mean to you as a consumer? It means your short-term interest rates, and even automobile loans, which are a bit longer, 5 to 6 years, those will even come down. Long-term rates, not so much, and may even go up. So again, that employment report is very important. In addition to the ISM number, which comes out later on this morning, it'll be much like ours. It'll probably be below growth neutral, but still just showing weakness, not a calamity, just weakness. And then look at about mid-month before the Fed meets, the CPI for the month of August. That number comes in strong, too much inflation, which I don't expect it to. I think it's going to be a little too high for comfort, but still give the Fed room to move. So, all in all, not a good report. Not bad, not good though. I know that's very frustrating for all of you. Sorry I couldn't be more helpful, but the data, I'm a data person, and the data aren't good. And I always have a problem with that. Data is a plural. Data is good, are good. Data are, I guess, in this case. The data drives me, and I'm sorry it's going to be driving all of us for a while. And until we meet again on the first business day of October. Now this is, of course, the first business day of September. Until we meet again, may your economic cup runneth over. This is Ernie Goss from Creighton University here in beautiful downtown Omaha, Nebraska, and thank you for joining in.